Hello beautiful traders, welcome back. In the first video of this series, we talked about technical analysis and confluence, and how traders stack multiple tools to find high probability areas on a chart. In the second one, we covered market structure, learning how to read higher highs, lower lows, breakup structure, and identify who is actually in control of the market. But here's the problem most traders still run into. If you've ever taken what looked like a perfect setup on the 5-minute chart, only for price to immediately reverse against you, you're not alone. One of the biggest mistakes is starting your analysis on the lowest time frame. You zoom into the noise instead of understanding the bigger picture. The problem isn't the market, it's the time frame. Here is a simple example. On the 5-minute chart, price went up, printed a 5-minute market structure break, retested then Fib Algo 786, and from here started another move up. But when we zoom out on the 4-hour chart, this move up actually stopped in a resistance of a 0.5 Fib on the higher time frame. On the 4-hour chart, we can see that price is still in a downtrend, making lower highs and lower lows. So while the 5-minute move up looked bullish, the higher time frame is still bearish. And unless you're a professional scalper, the 5-minute chart doesn't help you with bias. Today I'm going to show you a top-down method using daily 4-hour charts, 1 hour and 5 minutes that will help you understand the market context, align with the dominant trend, and refine entries without getting chopped up. At the end of this video, I'll show you a real trade using this exact process. Let's break it down. What is multi-timeframe analysis? It simply means looking at the market from multiple perspectives. Each timeframe tells a different part of the story. Higher timeframes show the overall narrative of the market. Lower timeframes show execution. Think of it like zooming in and out of a map. If you zoom in too much, you lose context. If you zoom out too much, you miss details. Good traders know how to combine both. Here's a very simple drawing. Each time frame is zooming into the same movement. The white line, labeled daily, represents the higher time frame structure. Here we see the market printing a higher low and higher highs. This means the overall trend on the daily chart is bullish. Buyers are in control of the bigger market move, and the expectation is that price will continue moving upward over time. The blue line labeled 4-hour, this one here, even though the daily trend is up, we can see here on the 4-hour chart that we have a little bearish movement. This is what we call a pullback or a retracement. Instead of moving straight up, the market pulls back before continuing the trend. So on the 4-hour chart, we might see lower highs temporarily, downward momentum and red candles. To someone looking on the 4-hour chart, the market might look bearish. But when we zoom out on the daily, we understand that this is not a reversal, it's simply a correction inside a larger bullish trend. Here on the right side of the image, we have an even lower time frame, the 1-hour time frame with purple. Here we see smaller internal swings within the market. Lower time frames show more detail, smaller trends, and short-term volatility. This approach helps you to tell the difference between a market structure change and a correction inside a bigger move. So it tells you what to look for, longs, short, or wait if the bias is not clear. Why higher timeframes control the market? Here's something every trader needs to understand. Higher timeframes control direction. And the reason for that comes down to who is actually moving the market. Markets don't move because of one trader clicking buy or sell. They move because of large flows of capital entering and exiting the market. On higher timeframes, like daily or 4-hour, the moves you see are often the result of institutional positioning, large funds allocating capital, major liquidity being absorbed or distributed, and longer-term market sentiment playing out. These participants aren't trading for a quick 5-minute move. They are positioning for moves that can last days or even weeks. Lower time frames are heavily influenced by short-term traders, scalpers, algorithmic noise, and small liquidity fluctuations. Because of that, the lower time frame often shows temporary moves that don't represent the bigger narrative of the market. And here is a simple example. We have some pretty nice pictures. On the 4-hour chart, price is clearly in an uptrend. It's making higher highs and higher lows, and also printed a market structure break. But if you zoom in on the 1-hour chart, that little pullback on the 4 hours looks bigger on the 1-hour chart. If we zoom in even more on the 5-minute, that looks really terrifying. Lots of red candles, lower highs, lower lows, lower high, lower low. If you're looking only at this 5-minute chart, you might think that the market is turning bearish. But remember, when you zoom out on the 4-hour, it's just a simply pullback inside a larger uptrend. And once that pullback finishes, the higher time frame trend usually continues. And as we can see, after retesting the Fib Algo Golden Pocket, price bounced and did another 7% up. That's why, when a lower time frame move is conflicting with the higher time frame trend, the higher time frame tends to win. The higher time frame has more capital, more participation, and more weight behind it. This is why you should start your analysis from top down. First, you have to ask yourself, what is the higher time frame doing? Then move down on lower time frames and find opportunities that align with that bigger picture. Because when your trade is aligned with the higher time frame trend, you're trading with the market's momentum, not against it. The process I use is simple and consistent. We analyze the market from the highest time frame down to the lowest, and each time frame has a specific role. Daily, 4-hour, 1-hour, 5-minute chart. Each one answers a different question. Starting with daily time frame. The daily chart is answering the big question. What is the overall environment of the market? Is the market trending up, down, or consolidating? On the daily, we are looking for major structure, key support and resistance levels, major liquidity zones, and macro trend direction. This time frame gives us the big picture bias. We are not looking for entries here. We are defining the battlefield. Next, we move on the 4-hour chart. This is where we analyze the market structure more closely. Here we look for things like higher highs and higher lows, lower highs and lower lows, breakup structure, market structure break. The 4-hour tells us whether momentum supports the daily bias. For example, if the daily is bullish and the 4-hour is also printing higher highs and higher lows, then we know buyers are still in control. That alignment increases the probability of long setups. As we can see in our picture here, we have our swing low, we have our market structure break, and price printed a new high. After the new high, came back, retested the Fib Algo 382, which is the Fib that needs to hold price if the momentum is strong. Then we drop on the 1-hour chart. This is where we start identifying potential trading setups. On the 1-hour chart, we are looking for pullbacks into key zones, reaction areas, confluence zones, and potential trade opportunities. At this point, we already have context from the daily chart and direction from the 4-hour chart. So instead of guessing, we are simply waiting for the market to give us a setup that aligns with the higher time frame narrative. And as you can see here in our example, that 382 had a confluence with an anchored view up and a value area high of the last move up. So this was our area for longs. Finally, we move on the 5-minute chart. And we use this time frame not for direction, but for precision. The 5-minute helps us refine the actual entry by looking for smaller structure breaks, confirmation moves, and momentum shifts. Instead of blindly entering a level, we can wait for the lower time frame to show confirmation that the move is starting. This improves risk management, entry timing, and risk to reward. And as we can see on our chart here, we have an internal 5-minute market structure break, a retest, and from here we have our entry long. And this entry long then gives us the bigger take profit area, which was a swing failure pattern of the last high. And this is how we get a good risk reward, but also we have a clear invalidation for our trade. So the workflow becomes very clear. Daily gives us context, 4-hour structure, 1 hour gives us the setup, and 5 minutes gives us the entry. The higher time frame answers what direction should I trade. The lower time frame answers where exactly should I enter. And when those time frames align, you stop guessing and start trading with structure. The goal of multi-time frame analysis is alignment. Alignment increases probability. Now, let's go through a quick example using the full top-down process. First, we start with a daily chart. We can see the market is making higher highs and higher lows, which tells us the overall trend is bullish. So our bias is clear. We are mainly looking for longs. Next, we move on the 4-hour chart. And here we also see that price is making higher highs and higher lows, supporting the daily bias. But we also see that price is pulling back currently, and in order to find our support zone, we use Fib retracement from the last low that causes the last high, and we get our 382 area here. We can also use an anchored VWAP, and we also have a confluence here. And let's see what a volume profile tells us here. Until the last high, we have a volume on the 382 and value area low on golden pocket. But as we know, if the trend is strong, 382 is the fib that we want to hold price. So this 4-hour pullback is simply a pullback inside the daily uptrend. In order to refine even more our trade, we go on the 1-hour chart. The 1-hour chart shows us a consolidation, a sweep of liquidity of all these lows here, and the retest on the 382. This is where a potential setup is forming, but instead of entering immediately, we refine the entry furthermore. So we go on the 5-minute chart. And here, we zoom in, and we see that we have the last green candle that causes the low here. This will be our market structure break. So on the 5-minute chart, we want to see a small structure break upward, a strong bullish candle from the level, and momentum returning in the direction of the higher time frame trend. Once we see that confirmation, the trade becomes actionable. So this will be our entry long here with stop of the low, and we are targeting higher prices. A little extra for you here. You might ask, well, I have my entry and my invalidation, but where is my take profit? Using the same idea of bigger time frames tell you what you need to know, we zoom out again on the daily chart. And we see that our last high, our last all-time high was here. According to liquidity concepts, which we will talk about next week, above this high here are most of the stops of people who shorted this entire move down and didn't take profits. So this will be our take profit for our trade, and see how it plays out. If you want, you can close at the high, or you can trail and get even more out of this trade. The logic of the trade becomes very clear when you use this top-down analysis strategy. The daily and 4-hour chart gives us the direction. The 1-hour chart showed the pullback, and the 5-minute chart refined the entry. Instead of guessing where price might go, we simply follow the story across the timeframes. In the final part of this video, we'll talk about common mistakes most beginners do. Mistake number 1. Starting your analysis on the lowest time frame, on the 5-minute chart or even on the 1 minute. You open the chart, zoom into the smaller time frame, and immediately start looking for trades. The problem is that without higher time frame context, every move looks important. A small bullish candle might look like a trend reversal. But most of the time, these are just minor moves inside a much larger structure. When you only look at the lower time frame, you lose the big picture. And without the big picture, it becomes very easy to take trades that are actually against the dominant trend. This is why the process should always start with the higher time frame first. Mistake number 2. Another very common mistake is ignoring important levels that exist on higher timeframes. You might find what looks like a perfect setup on the 5-minute chart, but right above that entry is a daily resistance level, or the trade is happening directly into a 4-hour liquidity zone. Higher timeframe levels represent areas where large participants previously stepped into the market. So when price returns to those areas, reactions are very likely. If you ignore those levels, you may end up entering trades that run straight into major resistance or support, which often leads to quick reversals. This is why you should mark daily and 4-hour levels first before even looking for entries. Mistake number 3. Trading every lower timeframe move. Once you learn about lower timeframes entries, another mistakes appear. You start trying to trade every small movement you see. But the lower time frame will always show constant moves. Not every move is meaningful. Many of those moves are just noise inside consolidation. If the higher time frame structure hasn't changed, those small moves often have very little significance. Use the lower time frame only when it aligns with the higher time frame bias, and only for entries, not for buys. Mistake number 4. Mixing timeframes randomly. Another issue is switching between timeframes with no clear structure. For example, jumping from 1 hour to 5 minute to daily to 50 minute to 4-hour charts without a consistent process. When you jump randomly between charts, you often end up confusing yourself. Every timeframe tells a different story. Without a clear workflow, it becomes easy to cherry-pick information that confirms your bias. Instead, your analysis should follow a consistent order. Daily chart down to 4 hour, down to 1 hour, and then finally on the 5 minute. This keeps your analysis organized and prevents emotional decision making. Mistake number 5. Misinterpreting pullbacks as reversals. This is one of the most damaging mistakes. You see a strong move down on the lower time frame and assume that the trend has reversed, but often that move is simply a pullback inside a larger trend. For example, the daily chart might clearly be bullish, but the 4-hour chart starts pulling back and prints a series of red candles. If you are looking on the 4-hour and 1-hour chart, you might think that market is turning bearish. In reality, that move may simply be the market retracing before continuing the higher timeframe trend. Understanding the difference between a pullback and a true reversal is one of the main reasons why multi-timeframe analysis is so valuable. Forcing trades when timeframes don't align. Another common mistake, entering a trade when the timeframes are telling different stories. For example, the daily chart might be bullish, but the 4-hour chart is currently trending down, and the 1-hour chart is moving sideways. In this situation, the market is not giving a clear signal yet, but you still try to force a trade because you feel like you need to be in the market. This usually leads to entering trades during consolidation or uncertainty, which is where the market becomes the most unpredictable. When timeframes are misaligned, it often means the market is transitioning between phases, either pulling back, building liquidity, or forming a range. And during those moments, patience becomes extremely important. As a trader, you must understand that not trading is also a decision. Sometimes the best trade is simply waiting until the timeframes start aligning again, because when the daily, 4-hour and lower timeframes begin to point in the same direction, that's when the market offers its clearest opportunities. A good rule to remember is this: if the timeframes are fighting each other, it's usually better to stay out. When they start moving together, that's when the real opportunities appear. So, the biggest takeaway of this video is simple. Most traders get lost on the lower timeframes because they are looking at the market without context. But when you follow a structured top-down approach, everything becomes much clearer. Start with a daily chart to understand the overall environment. Move to the 4-hour to analyze the structure and see who is in control. Use the 1-hour to identify potential setups and areas of interest. And finally, refine your entries on the 5-minute time frame, where you can wait for confirmation and manage risk more precisely. When you follow this process, you stop reacting to random candles and start trading with the market's narrative. So, first we covered the confluence trading and the tools we use on the chart. Then we learned how to read market structure and identify who is in control. And now you know how to combine those ideas using multi-timeframe analysis to create a clear trading workflow. In the next video, we're going to take this one step further and talk about order blocks and liquidity, and how understanding where liquidity sits can completely change how you look at the market. So, if you are enjoying this series and want to keep improving your trading, make sure you're subscribed, and I'll see you in the next one. Bye bye!